Well, hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Tuesday, September 16th. I am so thankful that you're here joining me watching the show. Kind of a quiet day here today, equity-wise. Not unexpected, given the treading water that normally happens going into a pretty significant Fed meeting this week. This is the first Fed meeting we've had in quite some time. This is the first, almost entirely certain rate cut that we've had in quite some time. When you think about the Fed over time, right, you're sort of in a rate hike cycle, in a rate cut cycle, or in sort of a no change period, right? And, there are times when we're in a rate cut cycle and there's this expectation every time they meet, they'll probably continue to cut rates. We kind of know what's coming. There are these rate hike cycles where every meeting conditions are such that you expect the Fed will continue to raise rates. And then there's sort of the quiet period where there's not enough sort of significant evidence. So there's no real expectation that there will be a change. Those inflection points, right? Those turns, right? When we go from no change to a cut or no change to a rate hike, those are challenging only because it's an adjustment, right? And so the new reality of what rate cuts will mean and the ripple effects that those rate cuts sort of create takes some time to digest. In the end, it's all about what's being priced in, right? And that's how it's often phrased, right? The market's pricing in a certain move at a certain time. And what I will tell you is similar to, right, company earnings. A lot of times it's less about what the company actually earns, right? What revenues they actually generate or how much they earn off of those revenues, right? It's more about the expectations that the analysts on the street have and what the company does relative to those expectations. And I think with the Fed, you probably are best served thinking of it the same way, right? You have this idea of, what the market is pricing in, currently pricing in a 25 basis point cut at this week's meeting. What that means is that for some outrageously unlikely scenario, they say they're not cutting rates, the market will react swiftly and severely. And again, that's why it's probably a very unlikely scenario. At the same time, they could lower rates 50 basis points. That is a very low but possible, sort of probability. So realizing what the market is pricing in and how we might be different is sort of the name of the game. At this point, I would say highly likely, if not absolutely certain, they cut rates 25 basis points. I don't think there's enough reason to do anything more than that right now. But I will tell you now it's about the expectations going forward, what we call the glide path, right? So if we lower rates this week and we, is the expectation still there that they cut another 25 bips in the October meeting and another 25 bips in the December meeting. And that's basically what the market is pricing in right about now. So if we hear anything different than that, expect a significant move. We'll see what happens. But, with that all being said, today being kind of a quiet day for stocks, pretty normal, given the fact that there's the specter of a rate cut or change in Fed rate policy coming up very, very soon. Having said that, what happened today? Kind of an unch day for the S&P 500 and the NASDAQ Composite, both slightly down from Monday's close. If you look at the S&P over the last 2 days, just chopping around here. The Dow about, a little bit worse, down about 0.25%. Same for mid caps, small caps, NASDAQ 100. None of these were down that much. So, I guess the story here is that stocks weren't up, right? And if you look at the daily chart of the S&P, looks like a big down day because we just didn't go up today. So let's not think of this as too negative of a day, but it is noteworthy that after the significant uptrend, the market so far this week has literally been treading water, just sort of hanging right at that zero level and waiting for closure in the form of the Fed announcement tomorrow. Worth noting there, and I would say the most important data point I may share with you today is the fact that the VIX is going up. And I see a comment on here so far here on our YouTube channel, Favin86, 100% agreed. I think you're drawn to the same thing I am, right? The only thing on the green on this front page is the VIX. So let's keep in mind, number one, the VIX is still very, very low, right? Volatility is still very low. I think of below 16 as like extremely low volatility, 16 to 20, kind of low volatility Anything above 20 is kind of elevated volatility. Anything above 30 is volatility. And that's the unofficial framework that I would share with you that has served me quite well. So the VIX is still pretty low, right? And we're below 20. The VIX is going higher though, right? And the VIX was down in the low teens. It's now going to the mid teens and getting closer to the higher teens, up about 2/3 of a VIX point today. I think it's too early necessarily to be saying about the change in the VIX, because again, the absolute level is still very, very low, but it is maybe the most important chart to watch here. And as we've alluded to a number of times here in recent weeks, when you have a market that's been going up as much and as long as we've seen off of the April low, particularly what we've observed in the last 6 weeks with kind of choppiness, July, August, now into a pretty decent start to September. Again, seasonally the weakest month of the year by far. Volatility is one of those red flag charts you look for. You look for a spike in the VIX as a sign of elevated uncertainty, elevated fear, and that would mean elevated likelihood of a significant drawdown. At this point, we're still okay, but I'm noting that the VIX has been just trending higher. 2 days ago, right, going into the weekend, it's down around 15 as of Monday's open, and now we're trending higher there. All right, looking at the bond markets, whole curve continuing to go down. I grabbed a chart of the VIX, by the way. I did grab a chart, I think, of the 10-year Treasury yield, just to kind of show you, the conditions here. Basically, the curve coming down, bonds rallying, sort of plays into this general idea that the latest data on jobs, implies economic slowing down, or the economy not growing at an excessive pace. As a result, kind of queuing up what we're going to hear from the Fed this week and with the subsequent meetings in 2025. So bonds starting to rally, rates starting to come down. Of course, the Fed is lowering the very, very short end of the curve when they change the target rate, going lower, but the longer end of the curve appears to be coming down as well. So what's happening is the entire curve is coming down. We're not really steepening, which is what happens a lot of times at this point when the Fed starts lowering rates, kind of have this natural steepening to the curve. The curve is actually remaining fairly stable, and I'll show you a chart comparing the 3-month point to the 10-year point that makes that case very, very well. Dollar going lower as well, and that's another thing to look at here. The dollar means a lot of things. I think it's hard to boil down into one thing, but I mean, you think of it in terms of confidence. I would say confidence in the U.S. markets kind of trending lower here. The dollar has been trending lower, and our current administration has made no secret about their desire to have a weaker dollar. We're certainly getting that, but the dollar is really starting to break through some key support levels. It's another chart to pay attention to for sure. Also, because non-U.S. markets, as you may or may not know, have done remarkably well in 2025, arguably much better than U.S. markets by most time frames, and so that weaker dollar certainly helping that story. All right, looking here, we can see the commodity space, the DBC up about 1%, gold slightly higher, 0.2%, silver slightly lower. Big movements in the commodity space were in the energy sector, with oil, natural gas, gasoline, futures, and ETFs all up pretty good today. Energy ended up being the top performing sector today. Has not happened very, very often, and you'll see that. Grab the chart of one of those integrated oil companies, and I forget which one it was. But I'll remember when I show you the chart here in a little bit. So one downside of looking at a lot of charts during the day is they're a bit of a blur. At least that's how my brain works. I've worked with some people like Tom DeMark, trying to think of others that are like this, that just have photographic memories and can tell you where the Nikkei was at a pivotal moment in history. I can barely remember the level of the S&P today. That is how my brain works, which is why I'm thankful that my discipline involves looking at the data and looking at the charts all the time, so I don't have to remember it. It's sort of helpful. But boy, I can never remember specific levels. Having said that, let's look at cryptocurrencies. Bitcoin up 1.3% today. We're touching 117,000 here. Bitcoin really starting to recover after bouncing off some support. And I'm pretty sure I did grab that chart to share with you. You can see most of the top 10 coins, except for Ethereum, having a pretty decent day today. So cryptocurrencies, arguably a pretty important risk asset, rallying just fine as the dollar weakens, as stocks are sort of stalling out here this week. Looking at the 11 S&P sectors, I mean, not great in terms of sector breadth. You can see only 3 of the S&P sectors were up today. Healthcare was basically unchanged, which means the remaining 7 were all in the red. Energy, by far the top performer, up 1.7% today. I think Apache was the chart that I grabbed now that I think about it. APA, sounds familiar. Made a new swing high today. Consumer discretionary and consumer staples, both up about 0.5% today. So also moving to the upside. On the downside, utilities down 1.8%, REITs down 0.6%, communication services and technology both down 0.4%. So again, it's just one day. Let's not draw too many conclusions here, but a couple quick observations. Number one, the spread between consumer discretionary and consumer staples has been pretty significant here. This is a bit of a different day, and that staples did a lot better than they have been. Defensive sectors, utilities, and REITs both down pretty significantly, along with communication services and technology, which are 2 obviously growth sectors that have been toward the top of the leaderboard here recently, with charts like Alphabet, some of the semiconductors resurging their uptrends. For now, a bit of a change here, sort of an unusual day and a different day than we've observed quite some time, with energy at the top of the list, FANG sectors toward the bottom, kind of value in the middle. Boy, I mean, I feel like breadth not great has been one of the bullet points for this week so far. Today, no change there. Notice that the breadth was kind of more neutral, but still skewing negative for the New York Composite Index. 54% decliners versus 43% advancers. The S&P 500, the least good, with the S&P, with decliners 62%, advancers only 38%, about a 2-to-1 ratio. Stocks down versus up in that large cap benchmark. If you want to know, one of the things that worries me, right? One of my analysts, my former analyst at Fidelity, Mark Dibble, always used to share with the portfolio managers and the research department. He would call it thoughts while shaving, and it would always be just some random open questions to ponder, things that you would like be coming up as you're shaving every morning, I guess is the implication. And for me, thoughts while shaving, the advanced decline lines are not going up. And even though the S&P has made new all-time highs in September, the AD lines are not looking remarkably strong, particularly in mid caps and small caps, where both of those are below their 50-day moving averages. So the S&P is well above its 50-day, and half of the advanced decline lines that I track are actually below their 50-day moving average. And that's not great. And so one of the conditions I think we have to accept here in September is that the market's been making new highs on weaker breadth. And we can see that with the percent of stocks above their 50-day moving average. I highlighted that earlier this week on the show. I'll show you the 80 lines here in a little bit. Not going up, just not confirming these most recent new highs. In the Magnificent Seven space, we have Tesla up 2.8%. That is certainly helping the consumer discretionary sector to the top of the leaderboard, as is Amazon, up 1.1%, both handily outperforming the S&P's meager returns today. Meta also up 1.9%. I did grab that chart to share with you here in a few moments. One of those holding support. NVIDIA down 1.6%. We talk about how in the semiconductor space, they're not all charts created equal. And you can see NVIDIA and AMD kind of in pullback mode. KLAC, Lam Research, and some of the Micron, in breakout mode. And so there's kind of a spread from stocks working versus not, just within the semiconductor space, just in the last couple of weeks. And I think those are important charts just to remember that as much as we think of a group like semiconductors as one thing kind of moving up and down, that's what the SMH or the SOX would kind of, imply. There's actually a bit of a spread right now from the ones that are working and the ones that are not. Intel is always kind of a weird outlier. It trades very differently than the rest of semiconductors, but even within the ones that tend to have a very high correlation, or actually do not have a very high correlation right now. Another thought while shaving, I guess I would say, in honor of the great Mark Dibble. All right, let us continue on here. As a reminder, we live stream every trading day after the close. It's fun doing this show. I enjoy it a great deal. I hope you pick up on the joy that I have creating the show when you watch it. That's my goal. Or hopefully I'm not making a secret of that. We are live streaming on Facebook, LinkedIn, YouTube, and X. And I appreciate you guys tuning in live. Those of you that are doing so, always fun to see your comments and questions. Please throw questions in at any point during the live stream. At the end, we'll take a question or two from the chat and answer it for everyone's benefit, I hope. Any of the questions we don't get to, we'll put them in the mailbag. We'll plan out all mailbag episode on Friday, and we'd love to answer one of your questions there. All right, looking at the heat map here. Not very much a mixed day, right? Is I guess the way I would say it. You've got some bright green, you've got some bright red, you've got a bunch kind of in the middle. The average color feels like it's kind of an amber, kind of this, alphabet, right? Which is basically flat for the day. Charts like alphabet obviously are remarkably strong. Today was sort of a breather day, and the same with others like Netflix, even ones that have been chopping around. This is really sort of a quiet day again, which is pretty expected going into this week's Fed meeting. So what does stand out? So on a day like today, where the average is kind of neutral, the brightest colors really jump off the page at you, right? So the stocks that are up a decent amount, the stocks that are down a decent amount immediately stand out. And I don't know about you, but for me, I'm kind of drawn over here today. I'm drawn of one big winner and one big loser, at least in today's trading. The big winner is the energy sector. You've got Exxon up 2%, ConocoPhillips up over 2%, EOG, Devon Energy all up 3.5%. Apache, if you glance at all of these charts, you'll see that Apache, which is the chart that I did grab, Apache, Valero, Occidental maybe just breaking to a new swing high. There's a small subset of this sector that are starting to look pretty compelling, right? Making new highs, improving momentum, improving technical structure. A lot of these charts are actually still pretty ugly, right? And you can see the energy sector is actually fairly diverse. I wouldn't call ConocoPhillips a great chart right now, right? It's sort of been lagging big time, and the big integrateds have a very similar vibe to that as well. Now, ExxonMobil, very, very close to powering to a new 3-month high, which I think we'll definitely want to highlight if and when that would happen. But again, it's a small subset of the ones that are really starting to improve, and we'll try to focus there for sure, as always. And then, for energy looking so good, utilities look equally as bad. And it's the biggest ones. You can see that utilities is not a very top-heavy sector. It's one of the benefits of this kind of heat map visualization. This is called the market carpet on stockcharts.com. Other platforms have heat maps in this sort of general vibe. I'm a big fan of this type of visualization. It's worth noting, right, on this, the way that this is set up, the larger the box, the bigger the market cap. It's not directly scaled to the size of the market cap. Otherwise, names like NVIDIA and Alphabet would be like the top 10 names would take up most of the screen. And then there are all these little pixel-sized companies because they're so big. So it's scaled a little bit, but you can really get a sense of, large to small, and particularly within the sectors, how much of a spread this is, right? So you can see, like within communication services, right? Alphabet and Meta are huge. And then there's a big jump down to like Netflix and T-Mobile and AT&T and Disney. And then there's another big jump down to like the rest of it. You see the same with tech, with like Apple and NVIDIA just dominating in terms of size. Utilities, REITs, really materials are a little less top heavy. They're a little more, I guess homogenous, I guess is the word I would use, right? So there's not as big of a variation on all of those. So with utilities in particular, no real, significant large companies that stand out. It's just most of them kind of went down today, and I think that's what stands out to me there. What else would I think about on this? Those are the two that are immediately drawn to me. Obviously, Meta, Tesla, Amazon doing quite well. NVIDIA and Microsoft, the two biggest technology stocks, and 3 of the top 4, if you include Broadcom, all down today. Not down a ton, not end of the world sort of breakdowns, but just not going up. So again, the lack of leadership in some of the mega cap names kind of stands out to me here as well. Final thing I would say is just, I guess it's more of a stock picking exercise with some of these other sectors, right? So like within healthcare, you have Eli Lilly continue to rebound. Within industrials like GE Aerospace making a new all-time high today. Caterpillar, which is a chart we highlighted, I think, on yesterday's show, resolving that symmetrical triangle to the upside. It's up another 1% today. So it's more, less kind of sector broad themes, more individual stocks having some movement there. Great reminder the benefits of stock picking. The last thing I guess I would say, I didn't grab Monster. I wish I would have. So I'm going to do it now. Consumer staples toward the top of the leaderboard here today. And, when we think of consumer staples, we tend to think, I don't know about you guys, but I tend to think of like, Tyson Foods kind of name, sort of those, sort of like classic food producer type of companies that, and those charts generally don't look too good. Like Kraft Heinz is one of those. I mean, these food products names have been, absolute disasters. But then within that same sector, and even within the same group, you have Hershey Foods, which actually looks fairly positive. Doesn't really look like a consumer staple. Looks more like a consumer discretionary stock, I would say. And then Monster, right? Soft drinks, making a new closing high today, new 52-week closing high. So there are charts even within underperforming sectors that are doing quite well. And for me, that is a great reminder of the benefits of scans and alerts. Whatever platform you use, I obviously use stockcharts.com heavily. I use a couple other platforms like Koifin regularly in my work, but I'm a big fan of using scans and alerts. I use stock charts for both of those, but I've done that over time on Bloomberg and a lot of other platforms. Optima, very, very good scanning capabilities and alert functionality. I would encourage you, if you are a trader, an investor that uses charts, which the fact that you're watching my show tells me you probably are, use whatever platforms you have available and scan for charts breaking out. The way you find monster beverage companies, type of charts that are making new highs is by regularly scanning for stocks that have constructive patterns, by regularly scanning for stocks that are breaking down through support. Find those things that you can review regularly. That has become a foundation of my own approach. It allows me to sort of always be able to identify some constructive charts out there. And again, there's nothing worse than finding a chart way after it's gone up a ton and thinking, how did I miss that one? It happens a lot. And even to professional investors, we would call it, we would actually look for stocks that we would have, at least at a Fidelity, we would have a bunch of stocks that we as a research team would rate buy, and then a group that we would rate sell. And there was some variation in there. But the neutral bucket was always really interesting. Like, which stocks do we have no opinion on that moves significantly? And that just told us we missed that opportunity. We missed the movement. We missed the story. And we would dig into that group to think, all right, how can we not miss the next big thing that's going to start to improve? One of the things I learned from doing that a lot as a research director was the benefit of scanning, right? If we don't want to miss stocks that are going to be up 50%, let's start scanning for things that are up 5% and just make sure we know all of those names and look for the charts that are starting to improve. So Monster Beverage Company, the way you find these is by running scans and setting alerts and doing it consistently. All right, that is it. We're going to get to the charts here in a moment. I do want to let you know, I do see some questions coming in, and I am thankful for that. I do want to let you know two things coming up. Number one, I will be doing a webcast next week. I was hoping to have the sign-up page and everything all set up for you today. I didn't, so hopefully tomorrow I'll announce the topic, the date, but save the date. Next Wednesday, we'll be planning a webcast. Should be a fun one. Have not done a webcast since the beginning of the summer, so I'm excited to get back to that. So I'll share with you the latest on that as well. And then I'll be speaking at the Orlando Money Show that is coming up October 16th through 18th. It's being held in Orlando. I think it's the Omni Champions Gate. You can find more information at marketmisbehavior.com/money show. That will get you to the webpage where you can sign up for that event. It's a 3-day event. Thursday, Friday, Saturday. I don't know exactly when I will be speaking, but most likely on Thursday or Friday, because I'll be flying back to Seattle Saturday morning. I hope you can get there if you're in that area or can easily get to Orlando. Make a point of going there, and please let me know if you're going to be there, and come to my session and come up and say hello. Anytime I've spoken at the Money Show, it's been awesome for people that watch the show, listen to the podcast, saying hello, sharing how it's helped them, sharing feedback. I'm open to any of that, and would love to meet some of you guys in person. I feel like in this day of, AI-driven video where it's hard to tell sometimes whether some things are real or not, two things I will tell you. Number one, this is real right here. And number two, I have found that in-person events are just even more special when it's so easy to do so much via video. So check it out at marketmisbehavior.com/money show. You can sign up for that event, and please say hello when you attend. All right, let's look at some charts together, shall we? Looking at the daily chart of the S&P 500, I mean, would you call this a bearish engulfing pattern? I'm asking my own question. You wouldn't, because it's not quite then. I couldn't tell from the daily chart there. Yes, it wasn't really. Would you call this like a dark cloud cover candle? I mean, technically, you probably could. Is it the best textbook example I could ever come up with? It is definitely not. The idea with the dark cloud cover, ideally, it's a much bigger day, right? You want a big up day and a big down day that overlap one another. These are more smaller, narrow kind of range days, because the ranges have generally kind of come in here in the last couple of weeks. So I don't know if I would hang my hat on that as a thesis. But we didn't go up today, and we kind of closed back at yesterday's open. So we're stalling out for now. We're still at 6,600 and change, which is a pretty strong environment. So what do we do in this environment? In this sort of chart with this sort of layout, I think of this market as innocent until proven guilty. I can share with you all sorts of reasons why the market should not go higher. Those go from fundamental and macroeconomic reasons to more technical reasons. For example, weaker breadth conditions certainly stand out in the last 6 to 8 weeks. However, the market keeps going higher, and as a trend follower, I want to profit from that incline in the slope of the trend for as long as possible. So what do? You look for lines in the sand. At least this is what I do. I look for lines in the sand to tell me that we're no longer in a position of strength. 6,500 kind of stands out as a good short-term level. That was the most recent peak at the end of August. That's also the 21-day EMA. We've had a number of pullbacks to at or around the 21-day EMA before the next move higher, which means by my read, we've got room between now and 6,500. We got about 100 points on the S&P and still be in good shape. We get below 6,500, I think you at least have to reconsider the strength here in the markets. Below that, 50-day moving average currently at 6,400. The most recent swing lows from August kind of in that 6,350 to 6,370 range. So that's sort of the general level where I would say we've got room. And if we would break those levels, I think we have some reason to be concerned. If and when that would occur, where do you go next? So I'd probably start updating some Fibonacci levels, but immediately I'm drawn to sort of this gap from the end of June, the 200-day moving average, all right around 6,000, 6,050. I think of it as an if-then statement. If we break support, then I would see downside to there. But again, that's all conjecture based on some downside rotation we haven't seen yet. Until and unless we stop making higher highs and higher lows, right? We're in an uptrend, and that's as I see this market. I mentioned things that concern me, things that tell me this market is not to be trusted. The breadth data not looking particularly good. The momentum has improved, right? And the S&P getting back toward that overbought region. I didn't see if we didn't quite close above the overbought level, and we didn't yesterday as well. We're kind of right at 68. So the RSI is still not quite overbought, but very, very close to doing so. The advanced decline data has all been trending lower, right? The New York Stock Exchange AD line, made a brief new high. I think that was on Friday of last week, but did not confirm it. The S&P made a new 52-week high on its 80 line, but did not confirm it. The mid-cap and small-cap breadth lines have not made a new high and are now both below their 50-day moving average. This one, the S&P's 80 line, is updated for today's close, and it did slightly undercut its 50-day moving average. That means 3 out of these 4 AD lines are below their 50-day. The S&P is nowhere near its 50-day at the moment, but the AD lines all seem to be breaking it. So the market's going higher, but less companies. There's less strength underlying that market as defined by market breadth indicators like this one. And we've highlighted other ones as well. The trend is still up, right? So I'm going to assume that trend goes up. And I mean, in terms of leading indicators, they're all kind of turning bearish here in September. At least the breadth-related ones definitely are. Volatility just starting to pop higher this week. Again, it's still very, very low in terms of historical levels. And I've got these horizontal lines. I'm not a fan of thinking of hard and fast horizontal levels as the most important thing. I think the change in the VIX ends up being way more important than we probably would think. So the fact that the volatility is widening is probably pretty important. But anything down kind of in the mid-teens is still very, very low. I mean, very low volatility, right? You can see what happens when investors get nervous. The VIX spikes above 20, above 30 is when we get really nervous. We're nowhere near those levels. So the beginnings of a pop higher are certainly starting to emerge on the chart of the VIX, not to a warning level where I would say, stop the presses, siren emoji, volatility is high. We're not there yet. But keep an eye on two things I keep an eye on here in terms of sort of like macro technical things that often start to flash a warning signal at or near a top. Spike in the volatility, which would mean the options market is getting nervous. Spike in credit spreads. We're widening in credit spreads, which would mean bond investors are getting nervous. Neither of those things are happening based on the evidence I'm reviewing right about now. One thing that is clearly trending lower is interest rates, particularly the 10-year Treasury yield. From mid-May, the 10-year yield was around 4.6%. This week, we're toying with 4%, which is where we finished the week on, actually, that was Thursday of last week. We got down right to 4%, actually slightly undercut that. And we're sort of right about there. But I think, so the TLT bond ETF is trending higher, strong momentum, clear uptrend. 10-year Treasury yield clearly trending lower. So just like the S&P is in a clear uptrend, bonds are also in a clear uptrend, and rates are in a clear downtrend. But if you look at the yield curve, it's relatively flat. This is comparing the 3-month Treasury yield to the 10-year Treasury yield. So sort of the shorter end of the curve and sort of the mid-longer end of the curve. You can see that level is almost identical. So the curve has generally remained, sideways. As rates are coming down here in the form of the 10-year, we can see that the shorter yields are actually coming down as well. And the Fed lowering the target rate this week most likely continues that trend. And so the whole yield curve is kind of drifting lower right about now. So there's no real steepening of the curve, which has happened at times because a lot of times rates will remain elevated on the longer end. The Fed lowers the shorter end and the whole thing starts to steepen. That's not really what we're observing here. It's more of a flatter yield curve. We might talk about that a little more tomorrow after we learn what we learned from the Fed. Of course, Fed meeting today and tomorrow, press conference tomorrow, or announcement at 2 p.m. Eastern, press conference after that, after prepared comments by Chair Powell. We'll certainly be monitoring those, watching those, be ready to share some reaction with all of you on the show tomorrow. So don't miss it. Bitcoin is generally having a pretty decent September. And I tell you, at the end of August, it did not look good. We had come off of a new all-time high. We'd had a couple tests of that 120 to 125 range, had pivoted in mid-August and starting to go lower. So I remember at the end of August, I'm thinking, boy, this level here, this range, this support area needs to hold, because otherwise we're really starting to break down through clear support. And this is a pivot point coming back from the December 24 and January 25 highs. That's pretty much where we stalled out in the spring, and now we're pulling back to that level. So resistance often becomes support. That's what's holding. So that 105 to 108 range, which is what I've highlighted here in purple, pretty important. The 200-day moving average has been steadily trending higher. It's going to end up kind of right in that area. So that's your level, right? I think as long as that holds, Bitcoin's still in a pretty good long-term structure. We start breaking below 105. We start breaking below that Fibonacci support, which is around 104 and change. Start breaking below the 200-day. This is a very ugly chart, but it is not yet. It's actually holding the support that it needs to. And I like the rally so far in September. I do own a decent amount of Bitcoin and Bitcoin ETFs right about now. All right, some individual stocks to finish things off. We'll take a question or two. We'll call it a day. Meta, similar to that chart of Bitcoin, right? Resistance from February around 740 serves as resistance again at the end of June. We gapped above there and then tested that level as support. We briefly broke below it and broke below the 50-day, but only for one day before bouncing back higher. So that 740 level, that is absolutely vital. I think Meta above that level is a very constructive chart. But 740 is where I have an alert set. I'm pretty sure I do, and I'm going to check that and make sure that I do, because a break below 740 would be a real issue. Otherwise, this is a really nice constructive chart with the momentum still holding in there quite well. Eaton Corp is a Northeast Ohio company. This is what I would call a dark cloud cover candle. That's a 2-bar or 2-candle pattern where you have an up day and a down day. We don't engulf day one's body. That would be a bearish engulfing pattern, but we get at least halfway through the previous day's real body, which makes it a dark cloud cover candle. It tells the next 1 to 3 bars more likely lower. 340 is sort of that level of support I would be watching. Those are the swing lows from August. And then right around Labor Day, as long as we hold that on any pullback, we're in very, very good shape. And I think this is a constructive chart. Remember, we gapped lower here in early August. We actually filled that gap now, and we'll see if that will hold. But overall, Eaton, I would say for now, still a pretty constructive chart. I mean, boy, what a great chart in the energy sector. Apache is kind of an interesting chart because if you look back here, we had a coil pattern, right? We had this rally and then lower highs, higher lows. We briefly broke below the lower end, but we never closed below it really, and then popped back up. And then from there, we broke above the upper boundary. And by breaking above the upper end of that coil pattern, we also broke above the 200-day moving average. It had been below the 200-day for over a year. So a beautiful, just rally off the April lows, consolidation pattern right below the 200-day, and then we finally break it. Like, that's just such a great classic technical setup. From there, we've broken up and followed through. The momentum has improved. So the RSI got above 60, which tells you it's a constructive chart. Most recently, we pulled back to an ascending 21-day EMA that makes my heart sing. I did a video on my YouTube channel, a week or two ago about the 21-day EMA and how I use it. This is a perfect example. I don't think I used in the video, but had it been then, I probably would have. But a nice test of that 21-day EMA, making a new 3-month high here today. So not all energy charts are created equal right about now. I think there are some constructive charts and some struggling ones. Apache is one of those that I think looks pretty decent here. All right, shall we take a question or two? And then we'll be done. Merdad Mithra, thank you so much for watching on the YouTube. I don't know if I've taken a question from you before, and I appreciate you watching live. You asked, do you see similarities between 98, 99, and now? Hear it from other veterans. I appreciate your question. That could be that might be the subject of the webcast next week. That's an hour-long webcast at least. I'll give you the 30-second version though. Yes, do I see similarities? 100%. What are the similarities? I started in the industry in June of 2000. To be totally honest, I paid very little attention to the equity markets before then. I was studying music and psychology, and I was very happy immersed in studying how to play trumpet and sing well, and then also thinking about how people think. And when I started at Bloomberg and learned about investor psychology and learned that there was a thing called behavioral finance, which was kind of growing, and learned that technical analysis was a way to understand those things and quantify investor behavior, like that's what drew me to the markets and excited me. So when I started in the industry, I wasn't investing in 98 and 99, but that's all everyone was thinking about was, I started and I will never forget how optimistic, how bullish everyone still was. I remember opening a brokerage account and the person I opened it with, because this is back in the day when you opened it with a human being, was like, it's all in, right? These things are pulling back, but technology is going to recover. Like all these .coms are just pausing before they rip higher. Like everyone was thinking, so many people were thinking that, and then so many got their faces ripped off. So that formative lesson of the challenges in the left side of a bubble, how hard it is to recognize that a bubble is bursting as it's happening, and then how much you just need to recognize that things change and get out of the way as quickly as you can. That has stuck with me to this moment. I still remember that vividly. So do I see similarities? 100%, right? Back then it was valuing companies based on eyeballs. The whole internet, e-commerce thing was very early. Social media was non-existent. So this idea that everything was going to be brick and mortar stores are dead and it's all going to be transacted online. That was the argument. And that worked until it didn't. And one of the big issues that came in after was the fact that so many of these kind of companies were not really making any money. They weren't earning. They were spending a ton and bringing in revenues, but just losing excessive amounts of money. And so that, are there similarities between then and now? 100% yes, right? 100%. Is it to that point where I think you need to be concerned? For me, it is, and I would say that what I remember from that period, and now that I look back at the last 25 years, is at that point, it wasn't, is technology gonna be amazing, right? Is computing power going to make things easier and easier? Is there going to be a point down the road where I'm able to do a live stream from my house that's out in the woods with not a great internet connection? The fact that it's even this stable, I mean, you didn't know all of those things, but I mean, you had the sense that it was going to go there. But that doesn't mean that those stocks and those companies are great buys today, right? It didn't mean Cisco was a great buy at that particular moment. It took years and years and years and years for some of those companies to recover, and some of them went away. And I have the same sort of issue with the AI trade now. There's no doubt AI is transformative, that the technology is going to change the way we do pretty much everything. It's going to change so much. However, does that mean I should be buying stocks at ridiculous valuations because the technology is so awesome? Like, I don't think so, right? Good themes, good technology doesn't necessarily mean a good stock here. So yeah, I'm concerned. Having said that, I own plenty of growth stocks, and I'm going to continue to own them as long as the charts keep going higher. So that's what I'll be watching. That was a long-winded answer. And Favin86, thank you so much for the tip on our YouTube channel. I appreciate that very much. So thoughtful. That'll do it for today, by the way. And I appreciate you guys watching. Thanks so much for supporting me and supporting Market Misbehavior. Hope this helps you navigate these markets. Please stay in tune as we digest the Fed meeting tomorrow. We've got another episode of the Market Misbehavior podcast coming up later this week. I'll be excited to share that with you. In the meantime, have an awesome evening. Be well, stay safe, and remember, it's always a good time to own good charts. Take care, folks.